Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And today, we're just going to do another velocity banking example and call it winning with using velocity banking. So the reason why we're going to be winning is because whatever's left over here, this money is going to substantially increase, and we're going to use velocity banking as a way to do that, right? So if you don't know what velocity banking is, all it is a strategy where you can easily pay off debts using lines of credit as your main tool. Okay, and there's only really two things that you need to do velocity banking. Number one is a budget, so I've already done that for you. So this person makes decent income, has some expenses, and has about $1,000 left over a month, which is not bad, right? Because the average American, I don't think, could have over $400 in savings in an emergency if something did happen, like a car broke down, right? And we see we have three credit cards, an auto loan, we have two student loans, and a mortgage. And so, again, this person's doing okay, but it'd probably be better to have something other than the $1,000 left over. So, what we're going to do is try to increase this number. And in order for us to do that, we're going to use velocity banking and select a line of credit as our main operating account. Now, I haven't gone over the strategy if you've never heard of it, but I'll just quickly demonstrate what it is once we select our operating account. So, what's the difference between the average American and the velocity banker? The average American pays things out of a checking account, and the velocity banker uses the line of credit to pay for things. That's really the only difference, and that's going to make a huge difference as well. And we're going to make two assumptions: that we make the same amount of income. So there's like two rules to the game. You can't make more income. And number two is you can borrow an unlimited amount of money. And that sounds insane, right? And I would think so too. But that's what the game we're going to play today. So we're going to have zero savings. And the strategy is well, since first we need to select our operating account. So what we need is a line of credit, and the line of credit is basically a credit card, right? All it is a financial tool where you can borrow money, pay back, and use it over and over again. But there's other types of lines of credit in addition to credit cards, like personal home equity lines of credit. But we'll say because this person is a homeowner, they can borrow up to $50,000 in the form of a home equity line of credit. So if you've never used one, it's based on the value of your house, kind of like a credit card based on the value of your house, although a little bit more flexible. And I've had two home equity lines of credits before, so right after I closed on my first home, I got like a home equity line of credit for 15 grand after 3 months, 3 to 6 months or something like that. And the next year I reapplied again, got 50,000, and I'll probably reapply soon, and they'll probably be like 150 or under 200,000 that I can borrow, right? And then so now, what we're going to do is just do a rearrangement of our finances, right? And so I'm going to copy all this. And let's see, without making more money, how we can increase our cash flow. And what's our cash flow? It's income minus expenses, right? Because what we're going to do is put our entire paycheck, this is the strategy, entire paycheck into the line of credit, expenses out, and then our line of credit balance is going to go down about $1,000 plus the except for the interest, right? And so first things first, let's go ahead and move some debts to increase our cash flow. What we can do is we have these very high interest debts that take up a significant amount of our cash flow. And so what we're going to do is we're going to move all of these into that home equity line of credit. And so if this total would be $37,000, so let's go ahead and move that here, $37,000 in our home equity line of credit, right? And once we do that, guess what happens? Zero, zero, zero. And so we went from like 1,000 to 2,300 in an instant without really doing anything. Amazing, right? So now what we got to do is just pay this off, right? So what we do is just do some formulas. And what we're going to do is also calculate the next month's balance. So if you just have a formula for that, it's really easy. It's G2 plus I2 minus your cash flow, which is this number right here, 2366.82, right? And then what we're going to do is take the average daily balance because that's how the interest is calculated. So there's this average function right here, right? And then you take the average, multiply it by the interest rate, so times 0.1, and then divide by 12 because the interest rate is annually quoted and you need to get the monthly interest divided by 12, right? All right, and then now what we're going to do is just copy and paste this until we see a bunch of red, right? And now if we see here, we see that it takes 16 months, a little bit over a year, to pay off this $37,000 in credit card debt. Okay, so now let's go ahead and write some milestones here. Milestones. And let's go ahead and do this. And what are we at? Month 16, right? So month 16, so 16 months to pay off 37K. And we did that all in one swoop, right? And so now we have a couple more loans, right? So we have a mortgage, a student loan, and the auto loan, two student loans, right? And I don't know if you ever seen how student loans work, but they don't give you just one student loan. They give you like, multiple loans at different interest rates for different amounts. And so here in this example, I've made two student loans for 10 years. When I used to do these examples, I used to do it for 5 years, and I looked at my old student loans. I was like, oh my goodness, they're for 10 years. And so I now made the payments amortized for 10 years, one for 15K, one for 10K, one at 5.5%, one for 6%. Okay, so now let's go ahead and do this. So how do we know which of these debts we should pay off first, right? So we have something called a debt payoff criteria. And there's two ways of doing this. One is looking for debts that have the lowest balance, highest interest rate, and highest payment. Or we could use a formula called a cash flow index, which tells us which debts we should pay off. So it's almost like a ranking system. And all it is you take the statement balance divided by the monthly payment. If I have several loans, right? Let's actually do a comparison. So this one, the highest interest rate is these two, right? The lowest balance is this one, and the highest payment is this one. So according to the traditional debt payoff criteria, I may want to pay off definitely student loan 2 first. But it's a little bit iffy as to whether you should pay off the auto or the other student loan. But let's just use the cash flow index formula. I like it. I like usually using both criteria as a measure of which one I should pay off. But I usually use the cash flow index, but it ignores the interest rate. So if you have a 0% loan, it actually tells you to pay that off quickly, like based on that formula. So again, I don't necessarily agree with that, but that's how it works. So all it is statement balance. Actually, let's do this. Let's get the new statement balances after 16 months. So if we go $20,000 in 5 years, right, and it's 3%, and after, we said, was it 16 months? I'm sorry, 16 months. Yeah, let's see what the balance is after 16 months. So it'll be almost 15K, right? And with the loans, the payments are all the same. The only thing that changes is that is the cash flow index and the balance. So let's do 15,000, 15,000 for 10 years at was it 5.5%? Yeah, 5.5%. And then let's go here, and this will be, was it 16 months? So it'll be 13,442. Okay, now we get student loan 2, so we do 10,000 at 6%. 10,000. All right, so now 10,000 at 6%. So let's take a look at what the balance is at. Month 16, 8986. Okay. And then at the mortgage at this rate, at 16 months, so $200,000, 2000, 30%, 6% at 16 months is going to be a 196. Okay. Let's see. All right, so now let's calculate the cash flow index of all of these. And so what we're going to do is just take this balance, which is 14956.12, divided by 359.37, right? And then this one is 13442.52, divided by 162.79. And then this one is 8986.19 divided by 111.02, and then this one is 196,692.09 divided by 1200. All right, so as you can see here, let me actually format this correctly. Where's the number format? Okay, so as you can see here, this is really not that intuitive, right? Because we have this low interest rate right here, yet the cash flow index is saying pay this off first. And why is it saying that? Because if you take a look here, right? If you pay off 14 grand, you get $359 back, right? Whereas if you pay 196 grand, you only get 1200, right? So that's why it's saying like ignore the interest rate. What you want is the balance to the payment ratio. And so this is kind of like a ranking system. And basically, if it's below 50, it's considered a, quote, inefficient loan, meaning you'll get a lot of money back compared to the balance. And if it's above 50, it's, quote, inefficient. And that makes sense because of the amortization. So because these are 10-year, 30-year loans compared to 5-year loans, you probably want to pay this off first, right? So that makes sense. So let's go ahead and do that. And what I'm going to do is just move this 14 grand into here. So let's just do this. Highlight this and do that. And then move this 14 grand into the line of credit, right? And let's go ahead and do this. Plus this. Oh, did I screw up? I always screw up because of the commas. All right. So now, what's our new cash flow? Guess what? This becomes zero, right? This becomes zero, okay? And then now our cash flow is 2726.19, all right? So now let's put in our new cash flow of 2726.09. Is that it? 2726.19. That's it. 19. Okay. So, wait a minute. Wait, I think I screwed up. I'm sorry, it's right here. So 2726.19. Okay, so now we just got to copy and paste this. All right, so now it takes us to how many more months? 1, 2, 3, 4, 5, 6, about 6 more months. So what's our new debt milestone, right? It's going to be 22 months. To pay off 20 plus 37 is 57K, right? Okay, and so according to the cash flow index, this one should be paid off next, but you know, it's not gonna. So if this is not below 50, this is just my opinion. I'll have to kind of do a little bit more research into this. You could kind of do something called chunking, meaning that if you just kind of take out little chunks, so let's say maybe even like $4,000, and then put it to what's it called? Put your entire paycheck into the line of credit, and then take out your expenses and still pay it off. You can do that, obviously. I'm not sure if I want to pay off the whole thing, but let's just do this. Let's just take out 5,700 of this right here. So 5,700, so let me just do this. 8986.19 minus 5,700. So that means you'd have 3,000 here. 3286.19. And then, right, so I'm going to put 5,700. And it takes us 2 months to pay that off, right? So again, we could do it that way if we're going to really be super efficient with our money and still do velocity banking. Another thing too is, let me just show you this velocity banking calculator. Let me just go in here. Hold on one second. So, and this is 22 months, right? So we have to actually find out the new balances of the loans. but let's just use this cash flow index model first. So A986, actually, let me do this. This is going to be $10,000 at 6% for 10 years. Okay. And hopefully I haven't lost all of you, but let's just go here. And now at 22 months, what's the balance? This will be 8584.66. All right, so we got 85844.46. And then now one of the things we can do is we just put in our velocity banking calculator to figure out how much it'll take to pay this off. Now, this is actually provided by Renatus because I'm a Renatus student. But if you ever decide to enroll in Renatus classes, you could get this calculator as well. But that's only if you enroll, and I actually get commission if I enroll you because I'm an independent contracted marketer. But let's go ahead and write this in. This is going to be 10,000 original balance, right? And the current balance is 8584.66. What's the interest rate? It's going to be 10 years at 6%. And then the payment is 111.02. And let's just do this. So what if I put the whole thing into the line of credit? I want to just see the differences between that and just doing it off in little chunks. Because I always recommend, like, oh, if you have like a lower interest line of a loan, then just do it in chunks, and it'll be, it'll be very effective. But let me right now, real time, just see what the difference is, and it's probably going to be minimal. But let's go ahead and put that 8584.66. 10% interest. And what's our income? It is $5,700. And what's all our other expenses? It's everything except for the loan we're paying off. So it would just be this and this. $2,862.79. So let's just go ahead and do 2862.79. And you could see that even if we did the whole thing, it'd only take us 0.3 years, right? So, but it wouldn't give us that much cash flow. But let me just put this in a chunk of 5,700. So the only thing that changes is the interest that's saved. Just a few bits. Okay, you know what? Let's just put the whole thing in then. All right, so we're going to put the whole thing in. Okay, so go down 2 months, and what's our new cash flow when we put our whole thing in? This is gonna be 0, right? And so now our new cash flow is 2837.21. So 2837.21. 2837. 837.21. All right. So now we have the next debt we paid off at the 25th month. So the 25 months, we paid off 67K, right? So we're getting some good traction here. And then the next one, I guess we can just do the student loan, right? So the student loan. So what is the student loan at 25 months? The student loan one. So that'll be 15 grand. And then 5.5. And this is going to be 162.79. Okay. But at the 25th, what's the balance? About 12 grand. Okay. Okay, so now what we're going to do is let's recalculate the cash flow index at this point. 7623. Okay. Well, let's just put in the calculator, see how long it'll take. So, all right. So normally I might do more thorough analysis, but we're just gonna I don't know if wing it is the right word. Just quickly see how long it'll be paid off. So 5.5, 10 years, and what's that payment? 162.79. 160. All right. So now let's just chunk the whole thing 12409.62, right? And then the living expenses will have decreased. So what is our living expenses? It's 2,700. So it's everything except for the loan that you're paying off. And you can see that it only takes 4 years. But I always like to compare different amounts of the chunk. If you want to just completely get rid of it, so 5,700, or just do it in chunks. Yeah, we definitely save some interest, but you know what? I'd rather take sometimes I'd rather just take convenience for a peace of mind, so that this is gotten rid of. If it's a couple $100, so what, right? But that's just me. All right, so now we're gonna pay this one off, right? And now we put that here, okay? And then this is gonna be our new cash flow, right? And so let me just make this. All right, so now our new cash flow is $3,000. Bam. So this is going to be gone pretty quickly. So now, all right, so our new cash flow is 3,000. Okay, and 1, 2, 3, and then now this is where we do the mortgage, and this is where we definitely need to do chunking, because I'm going to just show you this right here, and we'll see what month was this? This is month 29. So 29 months. And this is going to be 67 plus 15 is 93K, right? Is that right, or am I delusional? So 67 plus 10K is 70. I think it's 83K, my bad. 83K. Okay. So 15, so 25, 25. No, it's 82K. Oh, I can't even do basic math. I should really just sum this up, but I'm just too lazy to do that. All right, so 1582. Okay, so now we have to do the mortgage, and we figure out what the mortgage is at 29 months. So $200,000 at 30 years at 6%, and we're going to just find out at 29 months what the statement balance is. 193K. So one thing I always like to mention when doing the mortgage is that look, so this is kind of like in the middle of like 5 months into year two. So actually, first year, second year, 5 months into year three, just take a look at the first 2 years or first couple of years of how much interest you pay compared to the principal, right? And there's a reason why a 6% mortgage, yes, it is a 6%, but not really, because you're paying $231,000 of interest and you borrowed $200,000, right? So just be aware of that. Now, what we're going to do is just put this into our velocity banking calculator that will just do this for us. And so now I'm going to put this as the current loan, or current balance, $200,000 at interest rate of 6.30, and the payment is $1,200. All right, so now let's take a look at this. So our payment should only be now 1,500. 1,500. Okay. So now let's take a look at these different amounts. So for example, if I'm going to do the whole thing, you're actually going to see it's not quite efficient to do this. So 193,803.1. Okay. So let's take a look. Yes, the debt payoff is much faster, 5 years, and the accelerated interest is 52,000. So we don't pay 152,000. But what if we just put amounts in our line of credit that's just similar to our paycheck, 5,700, right? You see that there's another substantial savings in interest. So you don't want to put the whole thing into a line of credit just because it's in a line of credit, if that makes sense. I know there are people out there who say loans bad, lines of credit good. That's not, and their interest is calculated differently. They're actually not calculated differently. They're calculated the same. The only reason that you'd use, let's say, a higher interest line of credit is just as an easy way to be able to park your money and have access to your money. That's what it is. And there might just be a little bit of trade-off, but if you move this money into chunks from the line of credit to the loan, I hope that makes sense, because I know when I first heard this was like really confusing to me. You have an easy way to park your money and prevent segregation of income. But if you can see here, if I put this back to the entire balance, 803.1, and pay off the entire thing with a line of credit, the interest doubles, right? So paying off a loan with a line of credit, it depends, right? There's a it depends factor on the situation. So you can't make blanket statements like that. But let me go back here. So we'll pay this off in 4.5 years. So it's 29 months. So what's 29 months? So 2.41 plus 4.9. So that's 7.31 years. So 7.3 years to be debt free. So that'll be 267K, right? And then this is where we do that Dave Ramsey debt free scream, woo, right? And then now this is going to be 0. And then guess what? Cash flow of 4,200. That's insane. Now we're going to have 4,200 in our savings account every month. Now we have two choices. Obviously, we could deploy that money somewhere, maybe like a life insurance policy or something like that, or buy more stuff. Here's the thing: if you have 4,200 left over after every month because you paid off your debt, I mean, you could actually argue you're better off than that most of the population, and you don't even need to do any investing. I don't know if that's the best choice, but you can actually probably make an argument for that. All right, everybody. Well, this is Karina Atlanta Mentorship. So this is just another excuse to do velocity banking. We'll call it winning with money. I think Dave Ramsey has kind of like a video series titled similar to that, or maybe I just copied it directly. Who knows? But if you're interested in joining our group, go ahead and click the Google form link below. And also, don't forget to join our YouTube channel membership. It's only 99 cents a month, and we have a once a month exclusive live stream. And you have access exclusive to emojis, really cool emojis that I got hiring someone for Fiverr. And what else? Is there anything else that I need to talk about? No, I think that's it for today. Have a great day, and we'll speak next time.